back to Forex Trading, the foundation class. Is Angel Montesclaros, analyst for Market Insights Asia Pacific. On episode number 4, we will be discussing economic cycle and monetary policy. Without further ado, let's begin. The economic cycle is a natural fluctuation of the economy between periods of expansion or growth and contraction or recession. Factors such as gross domestic product or GDP, interest rates, levels of employment, and consumer spending can help to determine the current stage of the economic cycle. There are 4 stages of the economic cycle: recession, recovery, growth, and slowdown. Let us get to know each stage, starting off with recession. Recession is when the economy declines significantly for at least 6 months. That means there's a drop in the following 5 economic indicators: real GDP, income, employment, manufacturing, and retail sales. People often say a recession is when the GDP growth rate is negative for 2 consecutive quarters or more. As of the moment, the US has been experiencing a technical recession. Second is recovery. Recovery is the phase of the business cycle following a recession, during which an economy regains and exceeds peak employment and output levels achieved prior to downturn. A recovery period is typically characterized by abnormally high levels of growth in real gross domestic product, employment, corporate profits, and other indicators. Third is growth. Growth is the increase in the inflation-adjusted market value of the goods and services produced by an economy over time. It is conventionally measured as the percent rate of increase in real gross domestic product or real GDP. Lastly, we have slowdown. Slowdown is a period of slow economic growth, especially one that follows a period of robust growth. Unlike a recession, economic growth during a slowdown is not necessarily negative. As mentioned in the definitions provided earlier, there are factors of economic indicators we look at to determine the present economic stage we are in. Although many indicators can be used as a guide, the following are popularly used economic indicators to gauge economic cycle stage: consumer spending, gross domestic product, industrial production, employment level, and interest rates. Let us take a look at this chart to differentiate each stage. During the recovery period, the interest rate is low, meaning borrowing money costs less and you don't earn a lot in saving your money in the bank. Businesses and individuals are encouraged to borrow. Of course, the money you borrow will be spent on personal or business needs. Either way, consumer spending will go up. As a result, GDP will also go up. When the market is healthy, businesses will strive to meet the demand, increasing both the industrial production and employment level. After recovery comes growth. Since the economy has recovered from its wounds and is now experiencing growth, the central bank will slowly get back the stimulus it provided to the economy. Why can't the central bank just let the stimulus stay? Imagine stimulus as your medicine and the economy as a person. When a person is sick, you drink medicine to get well. Once you start to feel better, the doctor will decrease the dosage of your medicine until such a time you don't need it anymore. What happens when a perfectly healthy person drinks medicine he doesn't need? You could get sick or worse, develop tolerance from medicine. So when you're sick, the doctor has to prescribe you a stronger formulation because the weaker one doesn't work anymore. Continuously misusing your medicine and you might run out of options and just painfully wait till your body can't go on and die. The economy is also like that. The central bank will try to keep the economy healthy using the appropriate amount of stimulus. Too much free money on the market is inflationary. Inflation is good at around 2%. Beyond that, it's a disaster. And central banks, although powerful, are not gods. They can't make miracles all the time. Their resources have limits too, and if they keep on mismanaging the economy, there could come a time where they won't be able to help it anymore. So when the economy is perfectly healthy, the central bank has to take back what stimulus it provided slowly until such a time the economy can stand on its own. By doing so, the central bank has options in its pocket when in case the economy needs its help. During slowdown periods, interest rates are still high. Slowdown does not always necessarily be the road to recession. It's just a period where the market needs to cool off after getting too hot from economic activities. Think of it as a healthy market correction. Hence, the interest rates is high to discourage spending. GDP, industrial production, and employment level is also down. Well, in comparison to growth period. In the case of Australia, the RBA was able to move from recovery, growth, slowdown, recovery, growth, slowdown for more than 20 years. When slowdown was done incorrectly, too late, or too much, we will be seeing a recession. As what we are seeing in some countries now, businesses are down, so they are cutting off production and employment. Without enough money to spend, consumer spending and GDP are also down. To combat the effects of inflation, central bank will lower the interest rates and allow debt to fuel the economy. Then the country will go to recovery. Continuous recovery leads to growth. When market is too hot, slowdown kicks in. And that is why we call this the economic cycle. Generally speaking, there are two major periods of economic cycle: expansion and contraction. Expansion is the phase of the business cycle where real gross domestic product or GDP grows for two or more consecutive quarters, moving from a trough to a peak. So this is your trough here, and this is your peak. So from trough to peak is what we know as expansion. Expansion is typically accompanied by a rise in employment, consumer spending, and equity markets. It is also referred as an economic recovery. Growth and recovery falls under the expansion phase. Contraction, on the other hand, refers to a phase of the business cycle in which the economy as a whole is in decline. A contraction generally occurs after the business cycle peaks, but before it becomes a trough. According to most economists, when a country's real GDP, the most watched indicator of economic activity, has declined for more than two consecutive quarters, then a recession has occurred. Slowdown and recession belongs to this phase. In short, when the economy is experiencing growth in two consecutive quarters, that's expansion. Whereas if we are experiencing two quarters of negative GDP, then we are on contraction period. Other terms you need to understand are peak and trough. A peak is the highest point between the end of an economic expansion and the start of a contraction in a business cycle. Here's your peak. The peak of the cycle refers to the last month before several key economic indicators such as employment and new housing starts begin to fall. It is at this point real GDP spending in an economy is at its highest level. That's why it's called the peak. The peak is the pinnacle of the business cycle and its opposite is trough. Here's your trough. Trough is marked by conditions like higher unemployment, layoffs, declining business sales and earnings, lower credit availability. After the trough, recovery and expansion begins. In order for the central bank to steer the economy towards its preferred cycle, it uses monetary policy. Monetary policy is a set of tools used by a nation's central bank to control the overall money supply and promote economic growth and employ strategies such as revising interest rates and changing the bank reserve requirements. In the US, the Federal Reserve Bank implements monetary policy through a dual mandate to achieve maximum employment while keeping inflation in check. It is not only the central bank that control or affect the economy. The government has its means to do so, and it is called the fiscal policy. Fiscal policy is the use of government spending and taxation to influence the economy. Governments typically use fiscal policy to promote strong and sustainable growth and reduce poverty. I will not be discussing this on this webinar series, but leave a comment if you're interested to learn more about monetary policy and fiscal policy. There are two types of monetary policy a central bank implements. Quantitative easing or QE is done to support the expansion of the economy. It is also known as the expansionary monetary policy or accommodative monetary policy. It is done when the central bank purchases government securities or other securities from the market in order to lower interest rates and increase the money supply. Tapering, on the other hand, is the gradual winding down of quantitative easing. It is also known as contractionary monetary policy or tightening monetary policy. This takes place when officials believe that the economy no longer needs excess stimulus. This includes not renewing matured securities bought during QE, increasing interest rates, and decreasing the money supply. You can think of quantitative easing as medicine. When the economy is sick or weak, the central bank helps it by implementing QE. So during recession and recovery period, QE is usually done. Alternatively, tapering is similar to dieting. So when the economy is fat and juicy, the central bank slowly removes the help it provided. Think of it as your lender getting back his money when you're able to do so. The job of the central bank is to provide the appropriate amount and form of stimulus when the economy is shrinking and take back what it lends based on the capacity of the economy. Mistakes on the amount and timing of monetary policy can cause economic catastrophe. Too much stimulus can lead to high inflation and an economic bubble that will eventually crash and cause recession. On the contrary, too little stimulus can hinder the growth potential of a country. Going back to the economic cycle, on the left part of it, where recovery and recession lies, this is a period where the quantitative easing is applied. On the right side, where growth and slowdown is there, tapering is applied. So, let us differentiate what the central bank does during QE and tapering. During QE, the interest rate is low. The economy is not doing well, it needs help, thus they would implement QE. So what do they do during QE? They increase the money supply by adding credit to the commercial banks. They cannot lend money to people like us. So they will lend money to the commercial banks, and then the commercial banks will be lending money to businesses and individuals. They would also be purchasing government or private market securities, and the target is to lower the unemployment rate, increase consumer, business, and government spending. Opposite is tapering. So during tapering, interest rates are high. This is to discourage people from spending. Remember, the market is already hot. It needs to cool off a bit. How do they do that? By removing the credit they provided to the commercial banks. Remember, they lent money previously during QE. So during this time, they would be collecting the money that they lent out. Of course, portion by portion. They won't collect it as it is. They would also be removing asset purchase program that they did. So once the assets that they purchased before matured, they will not be renewing those anymore. That would put money back into their pockets. The target for tapering is to increase the average hourly earnings or income of individuals and promote higher inflation. As summary, quantitative easing is also known as expansionary or accommodative monetary policy. It is done to help improve the overall health of the economy. Tapering or contractionary or tightening monetary policy is done to prevent an active economy from overheating. So how do we apply this in trading? We buy a currency whose central bank is implementing tapering because they were increasing the rates and the value of their currency has more. While we sell the currencies whose central bank is implementing quantitative easing. Their interest rates is low and they're printing out too much money. Thus, it's not ideal for us to hold on to this kind of currency. We have two activities for this episode. The first one is activity number 5. The direction is to label the economic cycle phase described below. If you need time to answer, you may pause this video, but if you're ready, then let's go ahead and answer with me. Number 1. The economy is experiencing negative GDP for at least 6 months. The correct answer is recession. Number 2. It is a period of slow economic growth, especially one that follows a period of robust growth. The correct answer is slow down. Number three, it is the phase of the business cycle following a recession, during which an economy regains and exceeds peak employment and output levels achieved prior to downturn. Correct answer is recovery. And number four, there is an increase in the inflation adjusted market value of the goods and services produced by an economy over time. The correct answer is growth. If you got all four numbers correct, then add 1 on your final score to make it 5 over 5. For activity number 6, all we have to do is complete the table below using an upward or downward arrow. For example, quantitative easing, interest rate. What happens on the interest rate when the central bank is implementing quantitative easing? Is it going up or going down? For next, asset purchasing program under QE, and so on and so forth. If you need time, again, pause the video, but I am assuming that you're ready, so let's answer. For interest rates, during QE, it goes down. This is to help people recover from wherever losses they are experiencing by lending money cheaply to businesses and individuals. On the other hand, during tapering, interest rate is going up. This is to prevent the economy from overheating. During QE, asset purchase program is up, while during tapering, it is down. During QE, since they are printing much money on this period, money supply is up, and during tapering, where they are taking back the money that they lent out to the economy, money supply is going down. Finally, during QE, the commercial bank credit or the money they loan out to commercial banks are up, while during tapering, they took the money back. So this is down. To summarize the episode, we have 4 economic cycle phases: recession, recovery, growth, and slowdown. During recovery and recession, where the economy is on its weakest, the central bank is implementing quantitative easing. They do this by lowering the interest rates, making loans affordable for everyone, and purchasing assets from the market. During growth and slowdown, the economy is at its strongest. Thus, the central bank would be implementing tapering. Tapering is the winding down of the quantitative easing, or taking back all of the stimulus that they provided to the economy. They're raising the rates to prevent people from spending and actually encourage saving money. Ideally, we wanted to trade currencies that are implementing opposite monetary policies. One is implementing QE and one is implementing tapering. So, we will be buying those currencies that are implementing tapering, and we would be selling those currencies that are implementing quantitative easing. But although this is the ideal situation, the risk is lower and the profitability is higher. This is not always the case. There would be times that we would be trading currencies where the central banks are implementing both QE, or the central banks are both implementing tapering. So, since both of them are doing the same thing, how do we differentiate the two? How do we compare them? And what currency do we buy? We would be discussing that on the next episode, so stay tuned. So for now, I hope you learned a lot about economic cycle and monetary policy. I would be seeing you on the next episode. Bye-bye!